where he spends most of his time digging through things that ultimately lead back to the bond market and inflation. Ben, so welcome back to the show. Walk me through what is most important to your work right now in trying to assess the direction, or maybe just explaining how we got here so low in the 10-year yield.
Yes. So what we've been tracking, there's kind of two things here, I think, going on. One is that on a global scale, some of the econ data has begun to slow, and more importantly, some of the alternative data that we track with like search activity. So beginning somewhere in late March, some of the consumers' intentions to spend began to diminish. That was really across the board for both going out and staying in types of topics and goods and services. That continued really through the early portion of June. And if we look at on a global level, the average of those consumer search activities, we see that it has a decent correlation to the actual, to U.S. 10-year note yield, which is now somewhere around 1.25%, and we think that explains some of that drop in yield. Now, some of that data has begun to improve as we head into July now. Into August, which means we think that there will be somewhat of a low here, potentially formed in yields, maybe another bounce in volatility, and potentially press higher. The other, which we'll probably discuss here, is the coming shift between the transitory nature of the supply chain induced price bursts, those declining, and then some of these wage and more specifically rent pressures beginning to drive inflation higher. And that ultimately will be a catalyst potentially to give rise to yields.
So we're going to go through some of the data here in some of your latest analysis that shows the kind of step function for getting to those conclusions. Just generally, Ben, another one here, though, as it works into the Fed, is we are going to get some updates coming up pretty soon here over the next couple of weeks from the Federal Reserve. What role is that marginal turn towards a slightly more open stance to tightening, is I guess maybe the way I would describe it, right? There's ultimately the big picture. We know Jay Powell still wants to stay the course, average inflation targeting, but their language has changed. And as their language has changed, Ben, it seems like we've really been able to tie some of that timing to this deep compression of the yield curve. I mean, it shows very clearly on the chart, right, at the June FOMC. How does that play a role here? And what do you think we need to hear from the Fed in order to find some type of a bottom in the 10-year yield at this point?
See, that's the conundrum. The more that the Fed potentially talks about tapering, the more pressure there could be on actually lowering or keeping kind of a weight on long-term interest rates with that type of discussion. Now, it depends on how fast the inflation story is moving and also employment. I think that will ultimately be the key, but there's no doubt that the Fed has control, for example, of U.S. 10-year real yield. So you can explain roughly 80+% of the change in U.S. 10-year real yields, which are now around negative 10 basis points, using simple things within their communication. That could be how much they're talking about transitory, how passive they are, and the level of agreement. And right now, their level of agreement is very, very low, which means that there's something brewing behind the scenes. We've seen that with the debates between Kaplan, Brainerd, versus Brainerd, kind of the hawk-dove stance. But I think that also we need to watch that transitory language and passive language within their communications. Now, that transitory is stuck there in the second paragraph of the statement. We'll see if they make any changes to that this week. I highly doubt it. Their discussion of transitory and temporary price increases continues to go higher and higher. That hasn't abated. The only space we've seen that abate is in their passive language. So the amount of times they say things like, we need to wait, or some time, which was one of Brainerd's and Clarita's favorite terms, that started to drop. And that, in concert with the agreement being very low, means that it feels like we're getting to some kind of shift here, like you said, with the Federal Reserve, in that tapering, expectations are that it'll occur in the first quarter of next year. Now it seems like that might be getting pulled in a little bit to the tail end of this year. And how they discuss that and how they advance with the transitory and passive language will have a big impact on real yields. On nominal, it's a little bit of a different story, and that's a balance between how much would they crimp growth, and that's going to be a relation to, of course, how these data releases come out in the months to come.
So that last part there, Ben, we have to focus in on again, because this is where it gets very complicated, and it seems like some of the assumed framework a lot of folks I hear using can still be under debate, because what you're saying is that the more the Fed disagrees with itself, the more the Fed has to give a nod towards potential tightening. That's a force for lower nominal yields as it brings in the potential of crimping recovery. So if we've got that framework and how a more hawkish Fed could actually bring yields lower, if we look at the expectations for CPI, the chart that you've got that looks at swaps and I guess maybe break-evens to an extent, explain us the data, but I hear a lot of people looking at the break-evens saying this chart tells us inflation's going to remain low. But if those yields are really starting to accelerate on the back of Fed language, should we be so confident that this necessarily is a direct reflection of low for longer inflation? What if this is just low growth because we've got too much inflation right now?
Yeah, I mean, this is what we're all facing right now, and the inflation expectations storyline is confusing. We've talked about this as the summer of confusion, which is sadly, I think, going to lead to some pretty range-bound markets, like we have kind of discussed in the past year going forward. But inflation swap caps and floors, this chart we're showing here, which is effectively call and put options on headline CPI, are showing that the investor is right on the fence. So if you look at the 10-year, which is that pink line, shows that we have a 51% probability of seeing headline CPI above 2.5% for the next 10 years. So that's very much a shrug. The investors don't know really what to expect, and for the most part, if you look at yields, you're kind of led to believe that they are falling in line with the Federal Reserve, with the idea that we will see transitory price effects, or basically slowing in momentum in inflation. And I think that's what is somewhat bearing out right now within. If you look at prices paid, you look at some of the delivery times surveys, all of them did peak in May. Now, albeit by a very small margin, you might have to squint to look at the charts, but a lot of those kind of big indices that we've been tracking from these surveys that have everyone concerned have finally peaked in May, and we'll see how quickly they can retreat. On average, mean reversion for prices paid and for delivery times in the manufacturing space is somewhere around 10 months. So this will be with us until about April 2022. And if you look at actual kind of headline PPI and CPI, they tend to peak somewhere around 3 to 4 months after that mean reversion occurs. So a lot of this inflation story could sadly be with us, creating quite a confusing scenario. And that gets back to there's going to be something that happens here in the months to come. And that is that yes, transitory induced big supply chain price shocks are going to abate, most likely. But on the flip side, we're going to have the biggest component that is in CPI, which is rents, going to likely rise quite appreciably. So if you use Apartment List, Zillow to look at their rents, which are rocketing higher right now, they kind of project a somewhere around 4.5% to 6.5% OER on owner's equivalent rent of residences by the end of the year. Again, that could add somewhere between 1.2 to maybe almost as high as 1.8% to core inflation, which again will be a big deal.
Wow. So here's the apartment market, which is extremely tight, tightest on record. Sales volume there in the teal and tightness in orange show the implication of the prices will go. Ben, I just want to come back to one thing real quick. We only got about a minute, but back to the manufacturing delivery times. It's a pretty interesting data set you've got there. And the mean reversion, you're saying that when we get back to that kind of full mean reversion from the supplier delivery times, it's another X months before inflation peaks. Just bring me back to that point again.
Yes. So when we get this, so we look back to 1950 and looked for these peaks in manufacturing delivery times. And on average, it took 10 months to get back to a Z-score, back to average, at 0. But if you look then at headline CPI and PPI, typically it takes another 3 to 4 months after that actual mean reversion occurs to get the peak in those headline figures. Now, we'll see if that's the case here or not. We've had a lot of discussions about how this time is different, but really, if you do look back historically at all these global recoveries and global supply chain snafus, it's amazing how similar yields and tips break-evens, the dollar has traded in relation to these past global recoveries. So I wouldn't be surprised to see us somewhat follow that same trajectory. And like I said, the more persistent inflation is, especially if we get a lot of these transitory factors to back off and rents and wages to rise, talk about confusion. And it's going to make it tough on the Federal Reserve. But I still think that there's a good chance we do get this taper talk before year end. And then I'm still kind of in the consensus camp that we'll see the taper begin in Q1 2022. But like you said, the wrinkle is that doesn't mean the bond market all of a sudden is off to the races with higher yields at the long end of the curve. If they end up crimping growth, like we said, that becomes kind of a weight. And right now, our fair value on U.S. 10-year note yields is right around 1.5%. So that's kind of where I think yields will be sucked to and would find some decent resistance.